Hello students. Yes, so in my previous video I had explained on one of the important topics, that is capital structure. We have understood what's the importance of having an ideal or optimal capital structure in an organization, and how a financial manager is going to play a vital role in the organization when it comes to to make a decision on the financing mix. So now in this video I'll be explaining on one of the very important questions you can expect under section C for 14 marks, a must question from this chapter, right? It is on the factors influencing or affecting the capital structure. That is, to before you determine what should be your capital structure of your organization, you need to keep certain factors in your mind. So under that we have two segregation. One is internal factors, another one is the external factors. Now what does internal factors talk about? See, internal factors is something that which is going to affect the business internally. I mean to say, where these kind of factors should be dealt within the organization. Find where the decisions are held up in the hands of the people who are working, that is internal staff, that is with the internal organization as such. On the other hand, external is something which is related to the outside. You are going to consider the factors that which is going to affect you from the outside aspect. Fine. So the first internal factor what you have is financial leverage. Now what does a financial leverage talks about? See, finance talks about the money, and now what does a leverage talks about? See, leverage is something, it states about if you have a capital a structure, right? In that, have you infused the debt? Is there a debt element in your particular financial the capital formation? If yes, what is the level of leverage? What is the proportion of your owned money and borrowed money, right? See, the use of fixed interest is bearing securities, like you have debt, like where the preference capital along with the bonus and the equity in the capital structure can be described as a financial leverage, or it can also be called as trading on equity. See, by having debt and equity in the capital mix, as a company can enjoy the benefits of reduction in the in form of percentage of tax as well. So this benefit, so enjoyed, it will be passed on to the equity shareholders, that is in form of the high percentage of dividend. So always, as a financial manager, you need to see that what's the leverage, the financial leverage, how much you have dealt in with the capital structure what you have framed it. Fine. So the next internal factor, because see, financial leverage, that which is you are going to put it, you are going to pour it inside your organization, right? It's for your organization, for your growth, for your commencement, you are doing it. So always the financial leverage, it is connected with the organization, that becomes the internal factor. Very important point this is. Next up, you have a risk. Now what does a risk talk about? See, the risk can be like it can be measured to some extent by the use of ratios, or any kind of measuring of earnings, and the time, that is the interest earned and the risk attached to the use of a leverage, that speaks about the financial risk. And financial risk, it is added with the use of a debt, because um you know because if there is the increased variability in the shareholders earnings and the threat of insolvency of a firm as well, it can avoid the risk. If it does not go for the debt capital in the capital mix, then it reduces the return to the equity shareholders too as well, right? So as a financial manager, he must employ the debt capital in such a way that the benefit of that should maximize the returns to the equity shareholders as well. However, the concept of long run earnings, that is earnings per share alone, will not be considered as a determinant factor for structuring the capital. So risk is something which is associated, that which is going to measure the extent by the use of ratios, or the the measuring of earnings over a period of time. Well, the next up what you have is a growth and stability. What does growth and stability talk about? See, once the company starts getting the good response and a kind of cash inflow is something where the companies are receiving the money, basically the revenue generation is happening when it is all raised through the sales for growth and certain expansion programs of the company, which is of flowing off, will also be used as a source, right? And what it is going to do here, it is going to act as a flexibility. It is going to provide a degree of flexibility, and there will be a less dependence on the outsiders funds as well. When you are financially sound, when you are able to mint in the money out of your sales, what is going to happen? Of course, growth you are going to achieve. Apart from that, you can less depend. Of course, you are going to infuse it that capital formation, but still there will be less dependence on the outsiders fund. So a company which is like having sales, it must reduce its burden towards the debt what it has borrowed, because there's an inability of the company to pay the interest on debt. You are liable to pay the fixed rate of interest on what you have borrowed, isn't it? So directly it takes the company towards the liquidation, and hence the policies of the growth stability is going to directly influence or affect the capital structure of the organization. That's how the things are going to work it out there. The next step what you have is retaining a control. Now what does retaining, what does the term retaining control talks about here? See, it is that, see, if the existing shareholders they want to continue the same holding on the company, see, they will not encourage the issue of additional equity shares. See, the fresh issue of equity shares, it reduces the interest and holding over the company, and it will also come down, isn't it? So in the long run, again, it is going to affect the market value of the shares as well. The next step what you have is the cost of a capital. What does cost of capital states about? See, it is nothing but the expectation of suppliers of the funds, right? See, the objective of knowing the cost of capital is to increase the return on the investment, so that a firm should earn the sufficient profits in order to repay the interest, right? Whatever it has borrowed, if it has to pay the fixed rate of interest, what should be there? Company should be able to earn sufficient profits, only then it can repay the interest on the amount what it has borrowed. And the installment of the principal to the lenders also matters, and it is something like uh, minimum rate of return of a firm that earns on its investments. So here the debt is a the cheaper source of funds when compared to other sources. So the careful decisions has to be made in selecting the size of the debt, because what happens over here, beyond a particular ratio, that is the financing mix, the proportion or combination of debt is to equity, debt is going to increase the risk of the firm. So always determine as a financial manager, the cost of capital is definitely going to increase highly. It is going to increase, plus it is going to influence increase in terms of risk. It is definitely going to influence the capital structure of the organization, right? So the next step what you have is a cash flows. See, cash flows basically it speaks about the generation capacity of the firm, right? What's the cash inflows, outflows? It is going to increase the flexibility of a financial manager in terms of deciding the financing structure of the organization. What should be proportion, what should be the combination or mix of the debt and equity, preference equity debt, right? So the cash flow is going to permit the company in order to meet its the short term obligations, because cash is a current asset, isn't it? So to pay to pay the dividend to the equity shareholders. So here the interest to the debenture holders is going to matter, where the cash flow generating capacity of a company is going to help in meeting the commitments, where the insufficient availability of cash inflow, it takes the company to a disastrous or kind of a devastating situation as well. Fine. So the next step what you have is flexibility. Flexibility is nothing but the firm's ability in order to accept or adopt to the changes under the capital structure, like as and when there's a need or the circumstances that the company has to undergo any kind of the changes with the conditions, it has to go. So if the capital structure should be flexible, so that without much practical difficulties in a firm can change the securities in capital structure. That's how the flexibility factor is going to work. So the next step what you have is the purpose of a finance. What is this purpose of finance is all about? See, the purpose of finance is another, yet this is one of the important factors that which is going to affect or influence the capital structure. See, if a firm is engaged in the business transaction, it can make use of equity, debt mix, or can enjoy the leverage benefits of infusing, and if the funds are needed for non-profit organization in order to build, the social welfare kind of measure, it can meet its requirements only through equity capital itself, isn't it? So for an existing company, fund may be required for expansion, for diversification purpose, if it has goal of having a long run in the prevailing competitive market to sustain. Yes, it has to. And it may be like financed through a retained earnings. Like, in order to expand or diversification, what do you need? Of course, you want money, you want finance. Without finance, it is all nothing, all these aspects, right? So it can be financed through the retained earnings, debentures, preference capital, right? So the purpose of finance, it is going to definitely influence the capital structure. So the last point what you have under internal factors is asset structure. Now what does asset structure states about? See, funds are needed to make the investments, right? That is on both the assets. You have both fixed assets plus a current asset. See, investments can be met by long term sources, like through, you can go ahead with issuing of the debentures, issuing of equity, issuing of the preference shares, isn't it? So a portion of the current asset investments are also financed by the long term sources, that. Whereas the short term sources, they are used for meeting the working capital requirements, right? So hence asset structure also influences or affects the capital structure. Well, all these are the internal factors that which is going to affect the capital structure decision.